When you describe yourself as a portfolio manager, many people might be confused. They think of as a portfolio manager as somebody who is trying to make money by taking positions that are going to increase in value or generate return over time. You're doing something different.
Yes, certainly. What I do, listen, to think about it simply, Universa is a safe haven, but it's a particularly explosive insurance-like safe haven. And it's there specifically so, the more explosive it is, the more risk, systematic risk, my clients are able to take.
Many investors who hedged or who diversified gave up much of the upside in equities since the financial crisis, and we need only look at hedge fund returns, for example, to see that.
Yeah.
Now, hedge funds don't necessarily need to beat the S&P 500, but they do have to deliver value to their customers, and many of their customers or clients don't think they've been doing that. What did these investors who hedged or who diversified do wrong?
Well, again, modern portfolio theory sold us a bill of goods, and that bill of goods is that if you lower your volatility through diversification, it's this dogma of diversification. You lower your volatility, yes, you're also going to lower your arithmetic return, but if you get that ratio going up, all is well, and then you can take some leverage, which is kind of crazy in and of itself, that good risk mitigation requires leverage, and all is well, and you'll raise your long-run return. But it just hasn't worked out that way. As we diversify, diversification is really what we're doing when we diversify. Diversification, of course, in this environment too, where all correlations spike to 1 when you least can afford them to, it's a fundamental problem. And it's so contrary to the way I think about it. It's a completely new way of the way I think about it, constructing portfolios. And again, it's about focusing on the downside, mitigating the volatility tax.
So, if people want to understand a bit better what you do, and more, with some $10 billion under management now, people are beginning to see the value in what you do. Help us appreciate the nature of a tail risk hedge. What kinds of things are in the Universa portfolio?
Well, without getting into specifics, as I said, it's an explosive insurance-like payoff, but specifically explosive insurance-like convex payoff to what you have in your portfolio. So that's the important thing. We can't get too fancy, in my view, about, once again, thinking about exactly what that next crash is going to look like. We need to get all the contingencies right. So that what that means is, whatever your exposures are, you need to have in terms of tail hedging, you need to have very specific convex downside crash convexity to those.
But that you find that where? In out of the money options?
Well, yeah, there's a range of places where we can find this in the derivatives markets. That certainly is.
It's principally derivatives we're talking about.
Yeah, in order to get the type of asymmetry that I'm talking about, it really requires the use of derivatives. Yes. So that's a good simple way to think about it. Yes.
We learned in 2008 that derivative contracts themselves can blow up. Mm-hmm. Are the derivatives that you're, if you will, trafficking in now safer instruments than they were in 2008?
I'm not sure. Again, this is a contingency I don't want to have to think about. I don't feel like I have an edge in that. I don't feel like anybody has an edge in that. We all suffer from this hindsight bias where we think we had that last crash, for instance, figured out. We think we understood the cause and effect. I don't have the luxury of cause and effect. I don't have the luxury of thinking everything through exactly the way it's going to pan out, because I will absolutely be wrong. So my simple solution to that is, I don't take single entity counterparty risk. I face the exchanges. The saying goes, it's kind of like buying Titanic insurance from someone who's on the Titanic. It's just not a great idea.
The cost of protection, at least as measured by the VIX, and I know that that's an imperfect measure, has mostly been low, over the past 10 years. What if insurance gets more expensive?
What if it does? It's likely to be associated with an event. That tends to be how it works. We saw it happen very briefly last February. The interesting thing is, in this age, how quickly, when we see these flare-ups, how quickly it all comes back to cheapness again. So I expect we'll continue to see that. And the reason is, selling insurance is just sort of the most obvious and most straightforward way to sort of earn this extra yield. We're in this yield-starved, yield-chasing environment. Again, it goes back to central banks.
But how is it that those guys who were, if you will, selling insurance got destroyed in February and you didn't?
Because I'm on the other side of that trade. I mean, I remember, I'm not selling insurance. I'm fundamentally on the other side of that trade. I'm purchasing insurance from the market, insurance-like payoffs in the market. So there's a really pretty steady drumbeat of supply on the other side because it feels so good. It feels good structurally as a professional trader. It feels good sort of cognitively to make this little premium most of the time.